Wow, happy Thursday. Happy Thursday. Hopefully everyone's having an awesome day. I know here in Texas it's a little warm. Although I think it was like 98 degrees on my car thermometer for most of the way home. So which isn't really too bad. I mean, I'll take 98 degrees over 100. Um, but it's summer. It's to be expected. And we're about to go into August, which usually tends to be our hottest day. Something else that's extremely warm is our inflation. That's right. Fed lifts rates. Powell leaves the door open for another hike in September. Fed raises policies to 5.25 to 5.50 range. Central bank's inflation remains elevated. Powell says hike possible at December meeting. Maybe printing the trillions and trillions of dollars and writing a blank check to Ukraine may not be in the best interest for the United States when it comes to inflation. Um, just saying, there was going to be some blowback financially. Unfortunately, we the people have to suffer because all of our prices goes up because our prices are within the dollar, which is our government-backed currency. Federal Reserve raised interest rates by a quarter of a percent point on Wednesday, and the Fed Chair Jerome Powell said the economy still needs to slow and labor market to weaken for inflation to credibly return to the U.S. Central Bank 2% inflation target. I don't understand why it has to be 2%. Um, I think we could go negative, through deflation for a couple of years, maybe 2 or 3 years of deflation to get us back on track. I don't think that's too much to ask for. I guess that would increase our purchasing power because the dollar would be worth more than what it is today when you go through deflation. You don't want hyperdeflation. You don't want stagflation. You don't really want inflation. The hike, the, the Fed's 11th in the last 12 meetings set the benchmark overnight interest rates in the 525 to 550 range, a level last seen prior to 2007 housing market crash, which has not been consistently conceded for about 22 years. Interesting, the Federal Open Market Committee will continue to assess additional information and its implications for the monetary policy. The Fed said in the language has little change from June's 14th statement, in which left the central bank policy options open as it searched for a stopping point to the current tightening cycle. Powell made no promises either way, with September meeting 8 weeks from now considered live for another rate increase, though a continuing slow of inflation and weaker economy may also prompt policymakers to pause. But you want a strong economy. I mean, obviously, there's stuff that I don't know because I'm not in the financial world. A lot of that stuff doesn't really make sense to me, like a 2% interest rate, or not interest, but 2% inflation. But that seems to be what our government wants is inflation. In a press conference following the Fed's latest policy move, the Fed chief said that the central bank was very much looking for a totality of incoming data, and particularly study for signs that the economy is heading for a period of below trend growth, and that Powell thinks it's necessary for inflation to fall. You pretty much have to burn up cash. There's too many dollars out there. Not being serious, there's too many dollars out there. The best way I can describe inflation is that you have a pie. You can either have the whole pie, or you could cut the pie in servings. And the smaller slices you make is your purchasing power. Let's see here. The key price measures are still increasing at more than double the Fed's target, while inflation has been easing. That has so far happened with little apparent cost of the labor market, where the unemployment rate remains at a low 3.6%. That's actually rather low, to be honest. Economic growth has remained above the Fed's estimate, 1.8% trend. Economics poll by Reuters expected data on Thursday will show the second quarter gross domestic product expanded at just that level. I think the current inflation's at 3%. People say it's going down, but guess what? It's still up. I mean, I think it jumped up to like 4 or 5%, and from there it jumped another 3 or 4%. From there it jumped another 2% or 3%. So it's still high. That's why I say we need deflation, either at 1% or a quarter of a percent for a couple of years, to bring down inflation to where we have more of a constant slope opposed to a spike. But I don't know how that looks. I don't know what that would achieve, to be honest, in the long run. Let's see here. Paul acknowledged that the positive development of the inflation has fallen from the highs of last year without serious damage to the economy except to a few banks. But as the Fed enters a tricky period in its inflation flight, balancing the need for further rate increases against the risk of going too far, he says finishing the task on inflation will likely require some economic losses. I don't like those. I don't like economic losses. That means we, the people, lose when there's an economic loss. The government keeps getting paid regardless. The government still gets taxes regardless if we could afford to pay them or not. Here, my base case is that we will be able to achieve the inflation moving back down to our target without a really significant downturn that results to a high level of job losses, Powell said, but that is a long way to be sure, and we have a lot left. Reducing inflation is likely going to require a period of below the trend growth and some softening of labor market conditions, which means unemployment rates have to go up. The market's got to crash. We have to lose money, as in dollar bills, have to be taken out of circulation, which is not necessarily a good or a bad thing, in my opinion, how I understand things. As stated in the meeting last month, the Fed said it would watch incoming data and the study of the impact of its rate hikes on the economy and determine the extent of the additional policy firming that may be appropriate to reach the inflation target. Though inflation data since the Fed's June 13-14 meeting has been weaker than expected, policymakers have been reluctant to alter their hawkish approach until there's more progress in reducing the price pressure. I mean, you could just stop printing money. That might help. In their most recent projection issued at the end of the June meeting, 12 of the 18 policymakers said that they anticipate at least one more rate increase that would be needed at the end of this year for financial conditions to be restricted enough to ensure inflation continues to decline. Let's see, how long? Oh, not too much longer. Senior Powell said the decision will continue to be made on a meeting by meeting basis and that the officials can only provide limited guidance about what's next for the monetary policy in the current environment. It's certainly possible that we would raise the federal fund rates again at September meeting if the data is warranted, and would also say that possible, can't read today, that we would choose to hold a steady at that meeting if it was the right policy call. So he's saying he doesn't know what he's going to be doing in September. He cautioned, however, against expecting an all near-term easing in rates. We'll be comfortable cutting the rates when we're comfortable cutting the rates, and that won't be this year. Uh, I really hate to say this. From what my understanding is that it should stay at the 5% rate. It should stay at a higher rate for a few years. I mean, yeah, that's going to prevent some people from being able to take loans, which is also another issue, to be honest. But a high interest rates might be needed for our economy. U.S. Treasury yields slid in a choppy trading after release of the Fed policy statement, while U.S. stocks ended largely unchanged. Future markets showed little changes in bets on the path of the Fed rate increases over the remainder of the year, with small odds given a rise in September. The forward guidance remained unchanged as the committee leaves the door open for further rate hikes. The inflation does not continue to trend lower, says Kathy Boskernick, chief economist of a Nationwide. Our view is that the Fed is likely done with the rate hikes for the cycle, since it continues easing the inflation will passively lead to tighter policies as the Fed holds the normal Fed funds rate steady at or into 2024. I mean, it'd be interesting. Unfortunately, this, as they're trying to protect the economy, it's also hurting the economy. But hopefully, their goal is in the long run to make the economy healthier. I mean, the Fed also noted that the economy continues to outperform. This has been captured in data as varied as continued job growth, strong vehicle sales, and the gargantuan attendance numbers of the new Barbie movie to the Taylor Swift concert that's earned mention in the central bank's most recent Beige Book reported on the economic activities. Job gains remain robust. The Fed says while it's described that the economy is growing at a moderate pace, the slight upgrade from the modest pace as seen in June meeting. But I also wonder how many of these new jobs are they like living wage jobs, or are they high paying jobs, medium wage paying jobs? Are these mom and pop shops that are opening up to fill a need? Or is it all of the above? I don't know. I'm just asking a question. But his comments about the need to slow growth suggest possible bias towards a high rate to put more pressure on demand, though Powell said the Fed staff has relaxed a prediction of the recession in coming months outside. The analyst still thinks that it may take to finish the inflation flight. We would think that you need a recession or some deeper slowing at some point in order to get inflation back to 2%, said Veronica Clark, economist at Citi. So we're not having a recession in the next year. Inflation is not back to 2% either. You're still dealing with high inflation, and you still need to slow things more. Reporting by Howard Schneider and Michael S. Derby. Additional reporting by Shavea Riddle. Editing by Paul Simio. I don't know what any of this means, to be honest. I'm just making a video and reading the article because I don't really understand the nitty gritty of it. I just know that Congress out of control spending in Ukraine, our debt is being into play. Then you also got personal debt, whether that's through buying land or buying a house, buying a car. Credit card debt is really high, which is not boding well for the economy in the long term. And we actually need really Congress to cut spending, as they printed trillions and trillions of dollars between both Trump and Biden. And also, we as individuals need to pay down our debt, our personal debt. I'm not talking about the national debt. I'm talking about paying off our credit cards, paying off our car notes, paying off our land notes or homes or home loans. Those are things that we need to achieve. I don't know how that's going to affect long term. But that being said, that is my video for today. And have yourself a wonderful day, morning, or evening.